Today is Wednesday, January 15th, 2025. I am in Seoul right now. For this year or for the foreseeable future, I have to work in Seoul. I got transferred in-house to Seoul office 2 days ago, and I am at Apgujeong, right? KT Shinsa, so I have to be posted here for at least 9 months to 1 year. That I can determine whether I should go back to Gwangju or remain here. At this moment, I'm sitting on the fence, so I'm not determined. I have not determined whether to remain here or not, but I'm getting to like the position here. As I settled into my new environment and the living quarters, I decided to resume my daily English reading. So today, we're going to learn about inheritance tax. Probably some of you already know that Hyundai Group's CEO Chung Yi-sun will have to inherit significant shares from his father. And in Korea, the inheritance taxes are high, so the shares, the company stock security shares, have to be taxed, and that's a huge amount of money, like several $billions. So he has been accumulating a lot of cash as a dividend to buy the stock back from his father, and also to pay for the taxes. So let's learn about the inheritance tax in America. This article is from investopia.com, and the title is Inheritance Tax: What it is, how it's calculated, and who pays it, by Janet Berry Johnson, updated October 29th, 2024. Reviewed by Lee D. Uradu. Fact-checked by Suzanne Kvil-Haug. What is inheritance tax? An inheritance tax is a tax imposed by some states on the recipients of inherited assets. In contrast to an estate tax, an inheritance tax is paid by the recipient of the bequest rather than the deceased estate, right? Bequest, like a quest, bequest. You give something to someone and it's called bequest. The inheritance tax is not common, but let's remember this word, right? Bequest. The inheritance tax is not common in the US. In fact, just 6 states have an inheritance tax as of 2024. The taxation of an inheritance depends on the state in which the deceased lived or owned property, the value of the inheritance, and the beneficiary's relationship to the descendant. Key takeaways: inheritance tax is a levy on assets inherited from a deceased person. Not in Korea. We tax on the assets that are received from the deceased person. But here, today, we are going to learn about inheritance tax, and inheritance tax is a levy on assets inherited from a deceased person. An inheritance tax is levied on the value of the inheritance received by the beneficiary, and it is paid by the beneficiary. There is no federal inheritance tax. Okay, so state inheritance tax, right? Inherited assets may be taxed for residents of Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Whether you may pay inheritance tax depends on the amount of inheritance, your relationship to the descendant, and the state. What? Your relationship to the deceased, right? Usually deceased. And the state in which the descendant lived. Instead of deceased lived, right? Right? Deceased. I think this is wrong. Inheritance tax. A state tax, not a federal tax, levied on the value of inherited assets paid by the inheritor rather than the estate of the deceased. Understanding inheritance taxes. There is no federal inheritance tax in the U.S., while the U.S. government taxes large estates directly, imposing estate taxes and, if relevant, income tax on any earnings from the estate. It does not impose an inheritance tax on those who receive assets from an estate. Let me be clear. Let me read this one by there is no federal inheritance tax in the U.S., right? It's a state tax. While the U.S. government taxes large estates directly, imposing estate taxes, right, is called estate taxes, and if relevant, income tax on any earnings from the estate. So estate tax and income tax. It does not impose an inheritance tax on those who receive assets from an estate. I wonder what the assets are here. Is it movable assets or immovable assets? Liquidation. Inheritance taxes are collected by 6 U.S. states: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. However, Iowa will phase out its inheritance tax by 2025. Phase out. Iowa, right? When the tax applies, whether an inheritance will be taxed and at what rate depends on its value, the relationship of the beneficiary of the person who passed away, and the prevailing rules regarding where the descendant, the person with the estate, lived. Where the descendant lived, the person with the estate. The person with the estate. It's quite confusing. Relationship of the beneficiary to the person who passed away, and the prevailing rules regarding where the descendant, the person with the estate, lived. Is it called descendant? That is, inheritance taxes may be assessed by the state or states where the descendant lived or owned property if those states impose on inheritance tax. As a beneficiary, your state's inheritance tax rule, if any, doesn't apply. As a beneficiary, your state's inheritance tax rule, if any, doesn't apply. That's good, right? It depends on the deceased state. In other words, if you receive an inheritance from someone who lived in a state with no inheritance tax, you won't pay an inheritance tax, even if you live in a state with an inheritance tax. Right, it depends on whether which state the deceased lived. Normally, your inheritance must be greater than a certain minimum amount for you to owe taxes on it. That means that few people, only around 2%, typically ever have to pay an inheritance tax. An inheritance tax is not the same as an estate tax. An estate tax is assessed on the estate itself before its assets are distributed, while an inheritance tax may be imposed on the beneficiaries of a bequest. So, estate tax and inheritance tax. An inheritance tax is not the same as an estate tax. An estate tax is assessed on the estate itself before its assets are distributed, while an inheritance tax may be imposed on the beneficiaries of a bequest. So estate tax is about the real estate, right? And it's calculated before it is distributed. So the total amount of tax is first calculated and maybe distributed among the recipients. Inheritance tax is about is a levy on assets, and it's levied on the beneficiaries, right, of a bequest. How inheritance taxes are calculated. If due, an inheritance tax is applied only to the portion of an inheritance that exceeds an exemption amount. Above that threshold, tax is usually assessed on a sliding basis. Threshold, right? Threshold. Let me be clear on the pronunciation. I always thought the pronunciation is threshold. Threshold.
Threshold.
Threshold. Threshold.
Threshold. Threshold. Threshold. Threshold.
Threshold. Threshold. Threshold. Threshold. Threshold. Threshold. Right? The pronunciation is threshold. If due, an inheritance tax is applied only to the portion of an inheritance that exceeds an exemption amount. Exemption amount. That's good word, right? Exemption amount. Exemption amount. Exceeds an exemption amount. Above the threshold, tax is usually assessed on a sliding basis. On a sliding basis, that's a good term. Rates typically begin in the single digits and rise to between 15% and 18%. Sliding basis. Tax is usually assessed on a sliding basis. Rates typically begin in the single digits and rise to between 15% and 18%. It's on a sliding basis, slide, increasing or decreasing, depending on the brackets where the inheritance, amount of inheritance or bequest falls into, right? It's on a not pro rata basis, not on a daily basis. For example, if a state charges an inheritance tax on bequests larger than $100,000 and you receive $150,000, you could owe taxes on $50,000. Say that the tax rate is 10%, right? That's good expression. For example, let's assume, same thing. Say that the tax rate is 10%. Say that the tax rate is 10%. The calculation for the inheritance tax owed would be $50,000 multiplied by 0.1, that's 10%, and equals $5,000. Tax bill is $5,000. Remember that not everyone must pay inheritance taxes, even in states that levy them. Close relatives typically receive higher exemptions and lower rates. Surviving spouses are exempt from inheritance tax in all 6 states mentioned above. That's good. Spouses are exempt from inheritance tax. Close relatives typically receive higher exemptions and lower rates. Domestic partners, too, are exempt in New Jersey and Maryland. Descendants such as children and grandchildren are only subject to an inheritance tax in Nebraska and Pennsylvania. Important. Life insurance payable to a named beneficiary typically is not subject to inheritance tax. It may be subject to an estate tax if the estate or a revocable trust was the policy's beneficiary. Life insurance payable to a named beneficiary typically is not subject to an inheritance tax. So inheritance is a wide concept, larger than estate in meanings, right? The inheritance can be real estate, life insurance, some kind of a trust, right? It may be subject to an estate tax if the estate or a revocable trust was the policy's beneficiary. Estate or a revocable trust was the policy's beneficiary. So if the beneficiary is not a person but estate or revocable trust, then maybe the inheritance tax could be applied, and it's called estate tax, right? Estate tax. Inheritance tax thresholds. In most states, an inheritance tax applies to bequests above a certain amount, exceeds a certain amount, exceeds the exemption amount, exceeds an exemption amount, above a certain amount. In a few instances, the size of the estate is significant. For example, in a few instances, the size of the estate is significant. For example, in Iowa, if the estate is valued at less than $25,000, then no tax is due when the property passes to the recipients. In Maryland, inheritances from estates smaller than $50,000 are also exempt. There are further exemptions for heirs depending on how closely related they were to the deceased. Here are the details by state. Iowa, spouses, lineal ascendants, parents, grandparents, and great-grandparents, and lineal descendants, children, stepchildren, grandchildren, and great-grandchildren are exempt. Charities are exempt up to $500. The tax rate on others ranges from 2% to 6% of inheritance. Iowa's inheritance tax will be repealed in 2025. Repealed, right? Repealed. Here, repealed. Repealed, canceled, or phased out in 2025. So that's this year. Kentucky, immediate family members, spouses, parents, children, siblings are exempt. Immediate family members, that's another good term, man. Immediate family members. 가까운 친척, right? Immediate family members are exempt. Other recipients are exempt up to $500 or $1,000. The tax is on a sliding scale based on the size of the inheritance and includes a minimum amount plus a percentage ranging from 4% to 16%. It's on a sliding basis, on a sliding scale, right? Maryland, immediate family, parents, grandparents, spouses, children, grandchildren, siblings, and charities are exempt, as are the beneficiaries from small estates valued at $50,000 or less. Other recipients are exempt up to $1,000. The tax rate is 10%. Nebraska. Spouses and charities are fully exempt. Immediate family, parents, grandparents, siblings, children, grandchildren are exempt up to $100,000 as of 2024. Other relatives are exempt up to $40,000 and unrelated heirs up to $25,000. Nebraska lowered its tax rates to 1%, 11%, and 15% in 2023. New Jersey, immediate family, spouse, children, parents, grandparents, grandchildren, and charitable organizations are exempt. Siblings and sons, daughters-in-law are exempt up to $25,000. The tax rate ranges from 11% to 16%. Depending on the size of the inheritance and the familial relationship, right? Familial relationship. This is on a sliding scale. Pennsylvania, spouse and minor children are exempt. Adult children, grandchildren, and parents are exempt up to $3,500. The tax rate is 4.5%, 12%, or 15%, depending on the relationship. So here, that's a good term, right? Minor children, right? Here. Minor children. Adult children, that's good expression. Minor children, adult children, minor children, adult children, minor children, adult children. Tip: consider giving money gradually while you are alive to recipients instead of a lump sum bequest upon your death. With the exception of Connecticut, states usually don't tax gifts, right? Gradually, instead of a lump sum bequest. Consider giving money gradually while you are alive to recipients instead of a lump sum bequest upon your death. With the exception of Connecticut, states usually don't tax gifts. Inheritance tax versus estate tax. Inheritance taxes and estate taxes are often lumped together. However, they are two distinct forms of taxation. Two distinct forms of taxation. Both levies are based on the fair market value of a deceased person's property, usually as of the date of death. But an estate tax is levied on the value of the descendant's estate, and the estate pays it. Right? An estate tax is levied on the value of the descendant's estate, and the estate pays it. In contrast, an inheritance tax is levied on the value of an inheritance received by the beneficiary, and it is the beneficiary who pays it. It'll be confusing. Estate is just real estate. The distinction between the estate tax and inheritance tax with identical rates and exemptions might make no difference to a sole heir. However, in some rare situations, an inheritance could be subject to both estate and inheritance taxes. So inheritance tax, it doesn't matter who receives the estate, right? You can inherit both house or compound, same thing, in terms of taxation, and the money, right? Money or gift, policy, insurance policy. The latter is subject to inheritance tax. The former, the house, is subject to estate tax, and estate tax is levied on the estate. So whoever claims the estate needs to pay for the taxes, right? It's a two different distinct forms of taxation. Federal estate tax. According to the Internal Revenue Service, IRS, federal estate tax returns are only required for estates with values exceeding $13.61 million in 2024, up from $12.92 million in 2023. If the estate passes to the spouse of the deceased person, no estate tax is assessed. If a person inherits an estate large enough to trigger the federal estate tax, the descendant lived or owned property in a state with an inheritance tax, and the bequest is not fully exempt under that state's law. The sentence is a little bit strange. If a person inherits an estate large enough to trigger the federal estate tax, the descendant lived or owned property in a state with an inheritance tax, and the bequest is not fully exempt under that state's law. The beneficiary faces the federal estate tax as well as a state inheritance tax. The estate is taxed before it is distributed, and the inheritance is then taxed at the state level. Interesting. The estate is taxed before it is distributed, and the inheritance is then taxed at the state level. State estate tax. Heirs may also face a state estate tax. As of 2024, 12 states and 1 district still collected estate taxes: Connecticut, District of Columbia, Hawaii, Illinois, Maine, Massachusetts, Maryland, New York, Oregon, Minnesota, Rhode Island, Vermont, and Washington. If you live in a state with an estate tax, you are more likely to feel its pinch than you are to pay federal estate tax. Feel its pinch, right? Feel its pinch. Feel its pinch. Feel its pinch. Then you are to pay federal estate tax. The exemptions for state and district estate taxes are all less than half those of the federal assessment. Some states' estate tax exemptions may be as low as $1 million. If you live in a state with an estate tax, you are more likely to feel its pinch. Feel its pinch. Feel its pinch. Feel its pinch. Then you are to pay federal estate tax. Right? Double taxations. Maryland is currently the only state that imposes both an estate tax and an inheritance tax. Avoiding inheritance tax. While there are many exceptions and exemptions for inheritance taxes, exceptions and exemptions, right? Exceptions and exemptions for inheritance taxes, especially for spouses and children, residents with significant assets in a state with an inheritance tax may still want to minimize the exposure for their heirs. One common strategy is to buy a life insurance policy equal to the sum you wish to bequeath, and make the person you want to leave it to the policy's beneficiary. The death benefit from an insurance policy is not subject to inheritance taxes. Okay, the insurance policy's beneficiary. The policy's beneficiary. Bequeath. You could also put assets in a trust, preferably an irrevocable trust. This effectively removes them from your estate and your classification as an inheritance upon your death. You can set up a schedule to distribute the funds when you establish the trust. Interesting. Trust. You can set up a schedule to distribute the funds when you establish the trust. You can put assets in a trust, preferably an irrevocable trust. This effectively removes them from your estate and their classification as an inheritance upon your death. Warning: trusts are complicated and they must be set up and worded carefully to comply with state tax laws. Set up a trust with the help of a trust and estate's attorney. How much can you inherit without paying taxes? The 6 U.S. states with inheritance taxes provide varying exemptions based on the size of the inheritance and the familial relationship of the heir to the deceased. The federal state tax exemption exempts $13.61 million over a lifetime as of 2024. In most cases, you will not owe income tax on inheritances. In most cases, $13.61 million over a lifetime as of 2024. What is the federal inheritance tax rate? There's no federal inheritance tax. That is a tax on the sum of assets an individual receives from a deceased person. However, federal estate tax applies to estates larger than $13.61 million in 2024. The tax is assessed only on the portion of an estate that exceeds that amount. The tax rate applied is based on the sliding scale from 18% to 40%. Do beneficiaries have to pay taxes on inheritance? Whether beneficiaries have to pay taxes on inheritance depends on their familial relationship to the deceased and the estate where the descendant lived or owned property. Only estates or property located in one of 6 states that impose inheritance taxes may be subject to them. Surviving spouses are always exempt from inheritance taxes. Other immediate relatives, immediate family members, immediate relatives like the deceased parents, children, and siblings are exempt to varying degrees, depending on the estate. Inheritance taxes only affect more distant relatives and unrelated heirs. Right? Heirs, bequest. The bottom line, inheritance taxes only affect bequests made by residents in 6 states, and they mainly apply to distant relatives or those completely unrelated to the deceased. Spouses are always exempt from paying inheritance tax, and immediate family members like children are often exempt as well. Still, inheritance taxes can kick in at relatively small inheritance amounts. Sometimes as little as $500. Those considering bequests that could be subject to an inheritance tax might consider estate planning strategies, including gifts, insurance policies, and irrevocable trusts. Gifts, insurance policies, and irrevocable trusts compete risk-free with $100 in virtual cash. So this article was interesting, right? This article was prepared by Janet Berry Johnson, updated October 29th, 2024, reviewed by Lee D. Uradu, fact-checked by Suzanne Kvlag. So it was interesting. Before I close this article, I would like to go over the words that I decided to remember, right? Bequest. exceeds an exemption amount above an exemption amount on a sliding basis above a certain amount. Repealed in 2025, repealed. Immediate family members on a sliding scale, immediate relatives. Feel its pinch, feel its pinch, feel its pinch, likely to feel its pinch. Thanks for listening and have a wonderful Wednesday. Bye bye.